Good afternoon and welcome to today's webinar, TCB's Wealth Management, Investing and Estate Planning in Uncertain Times. I'm Allison Kaplan. I'm the editor-in-chief of Twin Cities Business. Thanks for joining us over the lunch hour for what promises to be a really enlightening conversation about navigating a challenging economy, managing finances during uncertain times. We've brought in a couple of true experts today to ensure that you're ready to hit the ground running in 2021. For those of you joining us, feel free to use the comment section on your screen to ask our panelists questions and network with one another. I have a feeling we're going to have a lot of questions for our experts. Let's meet them now. Hi, Bill and Mary Ann. Let's start with Bill. Bill Ringham is Vice President and Senior Wealth Strategist for RBC Wealth Management. RBC is a global organization that provides trusted advice and wealth management solutions to individuals, families, and institutions. They're forward-looking, innovative, and committed to helping their clients thrive and communities prosper. Bill joined RBC in 2000. He works with RBC Wealth Management Financial Advisors to develop appropriate wealth management solutions for clients with a focus on wealth transfer, including trust and estate planning, something I know we're going to get into a bit today, business succession planning, charitable planning, stock option planning as well. Bill frequently leads seminars and educational presentations for clients and groups on a variety of wealth strategy topics. He moderates classes for advisors as part of RBC Wealth Management's Advanced Wealth Manager program. Bill, welcome and thanks for being with us today.
Thank you for having me.
Bill is joined by Mary Ann Heine from Minnesota Bank and Trust, a subsidiary of the Heartland Financial USA, Inc. It's a state-chartered bank with more than $1 billion in assets located in Edina and Minnetonka. Minnesota Bank and Trust is a member of the FDIC and equal housing lender. Mary Ann has been a private banker for 28 years. She joined Minnesota Bank and Trust 10 years ago and specializes in helping her high net worth clients meet complex financial goals through a sophisticated wealth management process and assisting with their day-to-day banking and borrowing needs. She's been recognized as a 2015 Women in Business Award recipient by Minneapolis-St. Paul Magazine and a 2012 Top Women of Finance by Finance and Commerce as well. I know that just in preparation for today's event, I've learned a lot from both of you already. So thank you, and let's dive in. Well, first of all, obviously, we're coming out of an incredibly tumultuous year. We are trying to kind of wrap our heads around what's next. How are you feeling about 2021? Mary Ann, let's start with you.
Thank you. Thank you very much for the opportunity. And I want to say I am optimistic for the topic of this conversation. Obviously, we worry about those who have lost their jobs or their family members during this time, but we have just lived through the unthinkable, but are continuing to participate in the longest bull run ever. So it just goes to show that there can be some confidence in there being a downturn and a rebound of the market for those that are participating. I'm also optimistic in seeing the power and the presence of the retail investor, I think with more time on their hand or something, because I think that they're putting their money where their mouth is and investing in socially responsible investments. In fact, I tapped my portfolio manager's knowledge, and indeed, one of the socially responsible investment indexes have outperformed the S&P. So I think that people 20 years ago would ask about investing in companies that stocks that companies represented that cared about the environment and sustainability, and we would show them spec sheets, and maybe their interest would wane. But now we can hopefully see some increase there in their returns.
That's great to know. Bill, what about you? How do you feel about 2021?
Well, thank you, Allison, and I agree with Mary Ann's comments. I'm excited about it. First of all, I'm just, could echo your thoughts, Mary Ann, about those that have been struggling during this past year, particularly from an economic standpoint. Personally, I'm just excited to gather with people and see people again. I know that the vaccine will be an incredible opportunity for us to gather again. I will also see people that have gotten the vaccine just psychologically shift. They're just excited about the future. I have a sister out east who has just not come back to Minnesota for about a year now and is so excited to come back this summer after getting the vaccine. So just on a personal front, very excited about 2021 in that respect. From an economic standpoint, I think very optimistic as well. I had a chance to catch up a little bit with the head of our portfolio advisory group out of New York and talk a little bit about kind of the future of 2021 from a market perspective. And, I kind of look at it this way, there's really kind of two components that are driving the market. One is the kind of getting the herd vaccinated from a perspective of, hopefully by July, but then also just kind of what the growth of the economy can continually look like. And I think RBC is projecting about a 6.6 growth rate. And they look at it from a perspective of just how much money from a fiscal policy perspective has been incorporated into the economy. They gave me the perspective of 5.5 trillion, which is 5 times more than the economic downturn starting in 2008. That's 25% of our gross product, if you will. It's staggering from that perspective how much money has gone into it. So, that's one of the considerations that they're looking at. The other is interesting to me, and it's savings, which I don't really intuitively think about, right? They project that there's probably about, 1.6 to 1.8 trillion dollars in savings. And that's as a perspective of those that started saving after the last economic downturn, as well as those that, have just been living differently. I don't drive downtown. I don't eat lunches. I'm just not spending the money or going on vacations like I used to. And so if in fact, 20% of those savings are starting to spend, we could see projections into the 9 to 10% growth rate year over year. So I think that it's a fairly optimistic outlook on that respect. Obviously the only thing that would, maybe put a wrinkle in that is variants of the virus that might then cause a delay in that. But so from both personal and economic perspective, very optimistic for 2021.
It's amazing how all that coffee money adds up, right? When you're not spending it every morning.
Exactly.
So along that line, Bill, you had mentioned earlier that this whole experience and all of the volatility that we've been through actually gives you some great opportunity to talk to some of your clients and to think about planning or sort of reinforce the importance of it. Can you talk a little bit about that, or what have some of those conversations been like?
Yeah, no, it's a great question. There's a couple components of planning. One is just pure straight over tackle financial planning, and the other one is really kind of driven off of kind of wealth transfer and transferring your estate. What I saw in 2020 were those individuals that had a plan, a plan towards retirement, probably weathering economic downturns a little bit more, objectively. As the market was down significant, if you could look at your plan and determine where you were in proportion to how your retirement looked, it didn't fluctuate that much, right? And so we found the individuals that are within RBC that had a financial plan really having a much more positive outlook even in an economic downturn. And from planning, it's not just the quantitative, can I retire? It's really the, what are the concerns in retirement and goals and objectives that you have? And so we, are focusing very much on planning for our clients. And we thought and found that that was very beneficial. But from an economic downturn perspective, we were talking about, things like Roth conversions. If your IRA portfolio was down significantly, it might have been a phenomenal time to roll that into a Roth IRA that can grow tax-free. And so people took advantage of that. They then, saw the rebound occur in their Roth, which is a non-taxable once you start to take those distributions. We saw tax loss harvesting that were then now offset with the gains that were recognized potentially at the end of the year and things of that nature. from my perspective, in the seat that I sit in at RBC, we saw a lot of people do fairly significant planning from a wealth transfer perspective. The exemption's currently fairly significant, meaning the amount that you could pass on to your children. And so we saw individuals take advantage of, when their portfolios were down, transferring some of those particular assets in a very tax-effective manner to the next generation, using very sophisticated strategies that we would incorporate with their attorneys and their accountants, such as, dynasty trusts for the benefit of multiple generations, or, other kind of estate strategies as well. I think for even continuing on in a low interest rate environment, and I know Marianne, you'll probably address this as well, but we had a lot of individuals do intrafamily loans, and that's still a really viable option for people. The government gives us preferential tax or interest rates that, for instance, parents could use to lend it to their children. And those are based upon what we call the applicable federal rate. Those are incredibly low right now. I just looked, and it was like, it's 11 basis points for short term, and it's basically 1.62 for long term. So, we started seeing parents lend their children money, not only to buy a house, but if their children were out of work, here's a loan at an incredibly low interest rate. It's not a gift, it's a loan. And taking advantage of those particular things as well. And then just making sure that you have credit in line. I know that Marianne, you'll probably address that as well, but, from a securities perspective, we have lending capabilities against securities, and making sure those things were in place. And those people that had lending capabilities in place could probably breathe a little bit easier through that economic downturn than others that might not have.
Great, thanks, Bill. Marianne, what would you add to that? I'm curious if there are things that maybe you've advised clients in the past that they were suddenly more willing to listen to in the past year, or just different advice?
Right. Well, as far as, and Bill pointed that out too, that earlier, the savings rate, as long as the average return, when there's been a correction or a significant disruption in the market, has between 6 months and 2 years. So it's important to have reserves in place, and maybe now, we've learned that a year's worth of reserves, so you're not tapping into your investments and forced to sell them at a low. And I think as a banker, people have realized the significance of knowing their banker's name. Anybody who went to apply for a PPP loan, any business owner recognizes that importance. And as a banker, I try to encourage clients to set up credit lines in advance of when you need to access them. Ever since the 2008 crash and the subsequent 2014 rules that came out, it takes a lot more to get a loan. We have to prove your ability to repay. The first 2 pages of a tax return don't cut it anymore. So, having that relationship with the private banker to also champion them through the wealth management process, and to use those both in tandem, I think is important.
Okay, great advice. I see some questions are starting to come into the panelists. Just remember, if you're going to post something, do it to everybody, to panelists and attendees, so we can all interact and get the dialogue going. I know we're going to have tons of questions, and I'm guessing this next question in particular will have a lot of follow-ups, Bill, and we're so glad that you're an expert on this area. Let's talk about the tax proposals. It's a lot happening even just today as we speak. There's a lot of questions and uncertainty around President Biden's proposals. What are you telling clients now? If you can give us an overview.
Yeah, you're right. Yeah, I'd happy to give you an overview. And it is an ironic day for this panel discussion, given what's happening in Washington today with the current Rescue Act that's being released. We went into the end of the year in the election cycle, kind of following both, candidate or President Trump and candidate Biden at that point in time, and the difference in the tax proposals that they had at the individual, the corporate, the estate, and the payroll. And we had to redo that paper, 3 different times, right? Particularly since we didn't know what was going to happen in the Senate in January. And so once we came out with a 50-50 split Senate, knowing that any type of reconciliation bill would have to be, approved by Vice President Harris, that really kind of changed the dynamic of the proposals in place. And I'll kind of go into that in a little bit. But, we were addressing with clients the potential, ordinary income tax adjustment from 37 to 39.6%. We were looking at potential capital gains, going to ordinary income if AGI over $1 million. We were looking at payroll adjustments, the 6.2% that individuals get withheld, it cuts off at about 137,000. Well, if it all of a sudden comes back into play after 400,000, that dramatically changes an ordinary income event for higher earners, if you will, as well as, the corporate tax rate potentially changing, and then, the estate tax, and spending quite a bit of time in just two components of the estate tax. One, whether or not the exemption that is available per person of 11.7 million going down to either 5 or 3.5. And the ramifications that has at the federal level. We also have a state estate tax here in Minnesota as well, and then kind of looking at those particular components. What we're starting to tell is that story. So these are the proposals that the Biden administration has put in place, but now level set that, if you will, to a perspective of what can potentially really happen. We've just gone through a fairly significant bill today. The next one looks like it will be the infrastructure bill. And that is going to be significant. It's estimated to be $2 to $4 trillion. And it's going to include things like the energy, not only just roads and bridges, as well as, broadband and things of that nature. So it's significant. What we're starting to see and what we're keeping our eyes on are, how are we going to get through that in Washington? We don't feel it's going to be a bipartisan bill, because that would have to overcome a filibuster. So it will be another reconciliation package. And we can have two this year. We already had one. And because it's a fiscal year at the governmental level, not a calendar, there's going to be the next one in the fall. So that basically means, whether or not it could pass with a 50% majority with a vice presidential vote. And so if so, we're kind of looking at, a lot will unfold in the next 2 to 4 more months, or roughly, as that starts to kind of take shape. It's going to be incredibly expensive. And so we are going to anticipate that there will be revenue aspects of that incorporated in that particular bill. We are looking at things like taxes for the wealthy and corporate taxation, being probably the lower hanging fruit, if you will, being incorporated in that. So maybe the corporate rate going to a 28%. What will the tax on the wealthy, as they call it in the proposals, from an ordinary income perspective, and then ultimately, things like taxation on corporations, the GILTI tax, if you will, and then a couple of other ones. Carried interest might be on the table for that, as well as then maybe the estate tax rate for the exemption coming down to that 5 level, or 3.5 million. So we're kind of giving education, and then we're making sure flexibility is paramount, right? There are things that people can put in place to make sure that they can kind of get ready to pull the trigger depending upon what ultimately happens. We went into the end of 2020, and year-end planning was incredibly challenging for people, right? They didn't know where tax rates were going to go. So were they accelerating income or deferring income, or accelerating deductions or deferring deductions? That's a little bit of where people are at currently as well. So just making sure that as our planning process unfolds, we maintain options and flexibility in that planning process.
I'm glad you're following all this, Bill. It's a lot to track, that's for sure.
I'm not alone. Thank goodness.
Marianne, anything that you want to add to that before we move on to a question for you?
Sure. Well, just that we met with an M&A firm, and they were saying that they're going to see a lot more activity of business owners selling their businesses this year, because they may have to sell up for 20% more next year because of the increase in taxes. So again, the mantra of preparing yourself, and companies should always be preparing themselves to sell, because who knew that this was going to happen? And if they had that in mind, they might want to be accelerating that.
Interesting. Yeah.
Mm-hmm.
So, Marianne, let's talk a little bit about the market volatility. We don't know if we're done or where it's going. What are you advising as far as planning in terms of asset allocation, home equity, all of those things?
Right, and I bet this audience is pretty sophisticated on the significance of asset allocation and the importance. It means the most that you sit with your advisor and they really understand your lifestyle, longevity, and you set that in motion, and that you work with them to take the emotion out of the market, so that you don't faced with what will become increasing doomsday sayers out there that make people nervous and feel like they need to time the market and get out of the sell out of everything now. But then what happens and I have seen, people do that. I've sat in hundreds of investment review meetings through all these situations. And, what happens if you do time it once correctly and you do sell out, you're paralyzed to ever get back in the market. And it's important to know that it will return. I mean, we lost half of its value in '08 from 1312 to 6,000 Dow, and it has come back. But you want to have alternatives to tap into during those times, 6 to 2 years. But and that's where the credit lines, come into place. And people will often say, "Well, I don't need a credit line. I'm fine." But last thing you want to do is go to a banker when you're in a rush. For one, it's a red flag, and they take time to put together. So, and then asset allocation. Obviously, I think the audience is pretty well versed in the importance of that, and sticking to that. The clients who did stick to their guns and weren't swayed by their emotions did well. But there's also asset location. And that's very interesting too. There are investments that are fit far better in a taxable account, a IRA or 401k, versus a taxable account. So whereas I'm a banker, I would leave it to my advisor to and their accountants to advise on that. But this is something to think about.
Great, good advice. So let's move on a little bit to the markets. Let's dive in a little more. Bill, can you talk about the volatility and what you are expecting over the next, I know you look like 6 months out, or what are you expecting if you had a crystal ball? What do you think right now?
I think that if was the big word in that sentence. I wish I had a crystal ball, and none of us unfortunately do. In kind of Mary Ann's question and answer from an asset allocation, the markets are kind of forward looking, right? And so they're looking out ahead 6 months at this particular respect. And so they might have day-to-day fluctuation based upon kind of maybe what's happening and will the stimulus pass, will it not pass, but most of the time markets are already kind of taking into account a little bit about what's ultimately happening. We're starting to see a little bit in that in the Fed rate too, right? It's the Fed rate was for the 10-year was probably about 93 basis points at the end of the year. Now it's up to closer to 1.6. And so, there's kind of indications of the economy going up, from that perspective. And we're starting to see, kind of it was interesting because somebody told me price of wood. I never would have thought about it, but we're all sitting at home looking at what we want to do to our house, right? Figuring out, maybe I should get a new deck. Price of wood's going up 30%. That price is being passed on to us as consumers. And so there are those kind of, forward-looking aspects of the economy where, price increases, are being then ultimately passed on as well. And I couldn't agree more with Mary Ann from an asset allocation. It's just stick to your plan. If 2020 showed us anything, it was basically stick to your allocation. If you pulled out, when do you get back in? People are paralyzed on that. If in fact you're kind of looking out at the economy and what it's going to do, you have the ability to adjust your portfolio to be maybe a little bit more conservative, but at least you're kind of in that plan and you're sticking to it.
Okay. Mary Ann, anything you want to add to that?
Yeah, just that it is because people think if they time the market and they fall for the people warning of a crash, and then they will miss the return happens. They don't know when, but it happens quickly, maybe over a few days. So you don't want to be out of the market during those few days that the market really does rebound.
Right. Yeah, that would not feel good. Okay, well, good advice. Bill, can we talk a little more about income taxes and payroll taxes? What are you expecting in that regard? You touched on it a little bit. Advice and planning right now, whether it's for your employees or for your own personal estate?
It's a great question, and it's so hard to know at this point in time, right? We do, as I mentioned earlier, the proposal from the Biden administration was to, look at payroll taxes and incorporate, payroll taxes for those that are making over 400,000. There's that 400,000 magic number as well for the highest potential tax rate, going from 37 to 39.6. If you look at both of those combined, we had a taxpayer that made over $400,000 at a 37% tax rate at the federal level, exclusive of the Minnesota tax as well. If you look at going to a 39.6 plus add 6.2, that would get to a 45.8% tax rate at the federal level. Add Minnesota, and you could almost be above, well, you would be about 50%. And so, it's hard to really kind of go, okay, well, how do you plan for that? You make what you make. But what we see happening is that there'll probably be more discussion around things like non-qualified deferred comp again, right? The ability for a corporation to potentially kind of withhold part of the compensation and not incorporate that currently and provide it to the employee again later on. So there are those things that, we talked a lot about higher tax rates in the past. We haven't talked about them as much, but we anticipate those kind of planning opportunities coming into the future that employers will be looking at, particularly those that are kind of C Corp employers versus, those that have flow-through entities, if you will, for those. A couple of other things are tax-deferred growth vehicles people will be looking at again, such as, annuities that don't necessarily make you recognize that portfolio income as the annuity grows until you either take it out or annuitize it. I know that there are a lot of people that look at even insurance products to put money in as a tax-deferred growth vehicle. And then, the ability to change your portfolio, like Mary Ann said, between kind of this taxable versus tax growth of your own, whether it's your IRA is invested to growth and your tax or your taxable is invested towards munis or things of that nature. So there's that kind of allocation perspective, but it's if tax rates are going up, it's like, how do you accelerate income into a year that the tax rates are lower and defer income in the years that tax rates are higher, or consequently, defer deductions until tax rates are higher and accelerate those deductions in those particular tax years.
Great.
Allison, I did see a question from somebody about, if they've had money on the sideline, what do they do? When do they go in? And there is a debate: do you dollar cost average or do you go all in? And dollar cost averaging might sound like you can take advantage of the drop in the market and the assets are for sale, and but I've had people ask this question, and 4 years later they may still be in cash, and so it is. There are thoughts of just going in, meeting with your advisor to make sure that you're, they know your time horizon, but I think it's time to get off the sidelines, even though we are at this is the longest bull run in history. Even if there's a crash, I think that you can count on a rebound again. So don't be afraid to invest, because if you keep your money in cash, you will lose. There will be inflation, and you will have less purchasing power down the road. And I saw there was another question about REITs and growth versus value, and I can't really talk to the REITs, but it is interesting how it's been years and years of that the growth stocks, the tech stocks, have outperformed the value. So we'll see. I mean, maybe it's that time the value should start coming back. There's a tapestry of what investments do better. And each year it's different. You don't know which, well, the international or industrials or which one will do better. So that's where diversification comes in. You want to make sure that you have enough diversity to make sure you capture the different sectors that rise, but you don't want to worsify your portfolio and have too much diversity. And if you're not speaking to your advisor closely enough, and you let your, like, maybe a 401k money rest in an age appropriate fund, you'll find that you're not getting the reward for the risk that you might be able to take if you have the reserves in place.
Mm-hmm. Great. Yeah, we're getting a lot of good questions. Keep them coming, everybody. We'll try to get to all of them. And thank you, Marianne, for jumping right in with those. I know that a big mantra of yours, Marianne, is talking about retaining your purchasing power.
Right.
Talk a little bit about what that means and what advice you give your clients.
Sure, and really, what money's about. It's what are you gonna use it for? And there's your immediate purchasing power. And since I've always worked for a bank that's offered investment and wealth management and trust services, many times we'll look for future generations purchasing power too, and manage for. That's one of the items to think about, is that we're charged with managing the fund, the investment holdings to benefit the future beneficiaries. So there could be a long time horizon versus maybe when bonds yielded higher returns, the immediate beneficiaries would prefer just having the income, but not the growth. So it really is studying how long does the money need to last, and then there are sophisticated financial programs that can be put into play, and you want to make sure that whoever you're working with has a great handle on how the input of that information is handled and put in correctly. And people sometimes hesitate to share all of their investments with their advisors, but they can put them into very sophisticated simulations that take into account past reactions to the market, as well as current assumptions, and project out with a certain amount of accuracy the achievement of the goals. We kind of talk about the achievement of the goals to maturity, meaning when you pass, but you can really leverage some of these sophisticated financial tools out there now to help with decision making. Should I buy that cabin? Yes, you enjoy life, buy the cabin, you'll still be okay. Or do I need to sell it to make sure that I have enough for my health care, for example, in the future?
Right. Good advice. Bill?
Yeah, and I would, I agree with Marianne, and I would add to that, because, I agree with the concept of purchasing power. Inflation erodes purchasing power. Right now, and it's too early for the current, whether or not the interest rates going up is going to erode it in the short term. But, I get an opportunity to see kind of that come out for people that have done the planning, and we have a position on an inflation perspective for the future. But what gives people comfort is if they want to spend $70,000 in today's dollars throughout the remainder of their retirement, they can test that with increases or decreases of inflation, and make sure that what they've accumulated during their lifetime will allow them to maintain that purchasing power in today's dollars. And that's really the sophistication of the tool that Marianne is reflecting. And I'm a huge proponent of being able to see what that looks like in the future. And we have a lot of clients that do that. They go, okay, it looks like I can retire today, and the inflation rate is this. What happens if the inflation goes up? What will that do to my purchasing power when I'm 80? And so then it does become quantifiable, and they can kind of see the impact of inflation on purchasing power.
Right. Bill, I know you're also a huge proponent of estate planning. Can you give us your primer on that? What is some of your best advice to clients?
Well, I think one of the questions that you'd asked me earlier, I think there's a misconception that estate planning is just doing a will. And, it's much more global than that, right? From a perspective of, estate planning, we kind of look at what cornerstone documents do you need? And we don't draft documents at RBC, but we always want our clients to work with their attorney to make sure that they have documents in place, whether they're wills or they're a revocable trust and a will, to direct their estate to whom they want their estate to go to. But the other thing that, are really important are, healthcare directives, powers of attorney, and then some of the nuances of estate planning that aren't necessarily in your, front and center, but it becomes asset titling, right? Are your assets entitled appropriately? Are your beneficiary designations of all of those assets that pass by beneficiary aligned as well? It's interesting to me, we get a chance to kind of work with clients on putting together a fairly robust and detailed net worth statement. And, I can see all of their assets are joint with rights of survivorship, which is a great way to own assets. Most of the time, that's what happens when you first get married. You start accumulating your wealth. But I can tell somebody their will doesn't really do anything at first passing, because just automatically all goes to your spouse. And so, making sure that that part of your estate planning has been identified is part of the process as well. And then, just the discussion about what does your legacy look like? Estate planning is documents in place, but it's also incorporating legacy. And legacy means so many different things to so many different people. And I was talking to a client the other day, and we were talking about gifting to charity. Well, they didn't kind of connect the dots that charitable is a legacy as much as it is family. And it's what are your goals and objectives? Are they going to be met? And what kind of legacy do you want to leave? And that kind of is the wrapper, in my perspective, around a global look at estate planning.
Great. Good advice.
Yeah.
Marianne, did you want to add to that?
Yeah. I mean, just anecdotally, I have seen, and I hope to see, more attention to the estate planning work done by those that are currently maybe the alpha child, I think, that is taking over. A parent dies suddenly without their plan in place, or they haven't communicated the plan. And that person will end up, a lot of times being criticized by the family for selling the house for too low, or not doing something right. It's really important that the donors, who you're doing the estate plan for, convey to the family their intentions, and talk to their family their intentions before passing, so that they don't leave a legacy of a splintered family. You just see a lot of families that don't talk to one another, because they're fighting over a trinket or something. So I can't emphasize enough the importance of not only working with the titling, and because so much can be missed if it's not titled correctly, but asking that they communicate with the family members what their intentions are, and then when they've observed that hasn't been done, I think that there's going to be a onslaught of those that are going to be paying more attention, because they don't want that happening in their family.
Jason in our audience has a great follow-up question related to this topic of legacy. He asks, how do you recommend clients get advice about philanthropic plans? What's the best way to go about it? Bill, do you want to start?
Sure. There's a couple things. One is that, philanthropy means unfortunately different things to different people, right? And so there's the mechanism of which to carry out your philanthropic goals and objectives. It could be writing the check to your church. It could be giving stock to your charity of choice, or it could be creating, a donor advised fund or a private foundation. So there's the spectrum of the vehicles of which you give to help your philanthropic goals and objectives. In my opinion, the second component of philanthropy is then, how do you determine what causes you're really concerned about, and how do you move the dial on those causes? And it was interesting. It just reminds me of a conversation. I was talking to a client that they have 27 charities that they give to on an annual basis. And what they'd really love to do is to start to focus their philanthropic goals and objectives down to 4 that really then they could really kind of move and feel like they're doing something that really is passionate to them. And it's not just them, writing a check to any charity that keeps calling and asking you, but it's really like, okay, I've explored this one, and how am I going to really, continue on with that? And a third one that I would then add is as well as, how do you incorporate then family members into that philanthropic planning? And we have a lot of discussions around that as well. And it could be, parents are inviting their kids to the kitchen table, and they're basically saying, we've got this, donor advised someone and has this much money into it. We're going to make charitable bequests here, and we're going to give each of you $5,000 to give to your favorite charity. What charity is that? And why is it important to you? And so it gives that really that family discussion around philanthropy. And then there are organizations. We have a partnership with our ultra high net worth platform where they will literally, talk about philanthropy and the subjective components of philanthropy. You might not know what charity to give to that gives your philanthropic, it might be Save the Whales, but you don't know what charity saves the whales, right? And so it kind of that I'm looking into, what charities will then move the dial, as well as I want to endow a charity at the University of Minnesota. How do I do that? Kind of going through that process as well. So there's various facets of philanthropic planning, but I think it's a phenomenal question because it's how do you kind of make sure that those are kind of put in a package with them all.
Right. And I think one of the big things is just talking about it. Like you said,
Absolutely.
Sitting down at the table, talking with your family members, and then of course, talking with the experts like the two of you. We had a great question that came in. We had several great questions that came in even before we got started today, just to show you the demand for your knowledge. Here's one for both of you. How do you protect the assets of an aging parent, particularly with memory issues? What can a trust do, or what other avenues should you be exploring if you're sort of trying to do that while, taking care of a parent? Marianne, do you want to start with that one?
Yes, and I work closely with our trust officers who have been doing this for many, many years, and they said here that the best way to protect the assets of an aging parent is to have an appropriate estate plan in place, which we've hammered on, and someone appointed to assist upon incapacity and death. Sometimes there's a trusted family member who can help, but maybe if not, a corporate trustee. Anecdotally, from my own experience, having that corporate trustee sometimes as a go-between for the individual trustee can help because there won't be bias involved. And every estate plan will include a power of attorney and healthcare directivwant obviously those are, even when you have a child that turns, I think, age maybe 18 or 19, you'll want to make sure that they have their healthcare directives, because you won't have the power to help them. But we'll also include a will and revocable trust. A power of attorney can accomplish many things for an aging parent with respect to their assets, but a better solution might be to establish a revocable trust that will be professionally managed. A revocable trust is an attractive planning tool to accomplish the key, objectives of incapacity planning, privacy, and to avoid probate.
Great advice. Bill, I know that you said too that, there's a lot of gray area in terms of, particularly when you step in and take over for a parent who might be compromised. Hard to give steadfast advice, but what do you do? What do you tell your clients?
Well, I agree with Marianne. Everyone should have at least a power of attorney in place. So if you become incapacitated, that power holder can really kind of step into your shoes. Revocable trust deal very, very well with incapacity because a successor trustee can really kind of step in that, place. But, those are both mechanisms that have, the individual has really become incapacitated, and they've been kind of deemed almost incapacitated, if you will. What we find challenging, and I think those individuals that are listening find really challenging, it doesn't seem like my parents are making great choices anymore, and it just it just pains me when an advisor calls and said, this client of mine is a physician, he's brilliant, and he's just given more money or wants to give more money because he has to get his grandson out of jail. And it's like, okay, well, grandson's probably not really in jail, but it's that believable. It's that kind of like, they're not deemed incapacitated, but they're not necessarily making the best choices. And so having those legal documents in place is incredibly helpful. One thing that RBC has done is literally created a group that's really kind of client risk protection, group that our advisors can call and ask questions on. And we've even gone so far to make sure that we have really kind of this trusted advisor associated with the account. So if an advisor kind of sees, Mrs. Smith might not be making the best choices, they can call the trusted advisor, who might be a child, and basically say, we've been given permission to talk to you by your mother, and we're starting to see maybe those choices that aren't being made well. But it's a great question, because there's this, until you've been deemed incapacitated, there's this still, you're not maybe doing the things that you normally would have done. And how do you then make sure that there's protections around that, so that you don't get a call and basically find out that your parents have lost their resources as a result of those kind of decisions.
Right. Did the two of you watch the TV show Succession? I'm thinking next season, after the episodes, we need to do like conversations and get your reaction to what's happening. I'd love that.
Yeah, I've had clients that remind me of that parent, that there. Yeah, definitely. And what we're dealing with right now.
To do Succession.
Right. Here's another question from the audience. Besides annuities, what sort of investments do you suggest that would grow and still protect the principal? Marianne, anything you'd advise?
Well, I would say that annuities and variable annuities, you're essentially paying a premium for that security. So, over time, you really want to solve for low fees and great service. And, obviously being on the bank side, I might have a bias, but if you're going to pay for the extra security, to be comfortable, but you can also achieve that by having reserves in place, because historically the downturns and the loss in the markets haven't lasted as much as more than 2 years. So it just, I know people, I figured people would be wanting to know those tools when you saw the topic of the conversation, but it will cost to protect yourself more if you need that.
Right. Bill, anything you want to add on that? Marianne?
And I have to admit, I'm not the investment expert here at RBC Wealth Management, but I would agree that it depends a little bit on kind of asset placement as well. We've talked about kind of that annuity structure for the tax deferred growth on that component. I do think that it's probably frustrating for the municipal market because interest rates are low. But if you look at kind of tax rates going up, the benefit of tax-free bonds becomes even better.
Right. Okay.
Right.
We could keep firing questions at you all day, but to be respectful of everybody's time, especially yours, I want to make sure to ask both of you this. When you kind of reflect on what we've just been through this past year and what we're still going through and sorting out right now, what would you say are your biggest lessons, things that you will kind of carry with you or that might even change the way you advise or think about investing and planning? What do you carry on from this crazy time? Bill, do you want to start?
That's like broad. I think from a perspective of living through 2020, from my basement office, because I can't go downtown, there's a lot of things. One is kind of the human component of just even being able to have these kind of calls and carrying on the efficiency of a new technology, being able to meet with clients that happen to be in Hawaii or California or New York at a drop of a hat. So I think that those aspects that we've looked at that we can gain efficiency in a business perspective that are really important to just make sure that we don't lose kind of that interpersonal stuff, but make sure that we leverage those particular efficiencies. Another one that comes to the top of my hand is really just having a plan and really kind of sticking with it, and those that we saw having a plan, a financial plan and an estate plan, they want to revisit it. They want to know if in fact it's changed or altered as a respect of all of the things that are happening within the economy or their family. But as long as they have it, they can then react with it. And then ultimately, stick to that plan. Marianne, you brought up the concept of pulling out of the market because you were scared. Well, then when do you get back into it, right? Versus understanding what risk a downturn has on the portfolio mix that you do have, being comfortable weathering that and how long you have a chance to then bring that back up again. And we saw, great success in that respect. And so, I think the biggest one is have a plan and stick to it.
Great advice for lots of things. Marianne, what about you?
Yeah.
What are your takeaways?
And well, to recap, public service announcement, I think it's, if since we've just lived the unthinkable, if this doesn't motivate people to get to know their banker by name and get to know their advisor by name, I don't know what will. So I think that again, that can't be emphasized enough. I think reserves have now, I think we can feel confident suggesting where the old thought was 3 to 6 months, a year worth of reserves might be appropriate. If like Bill had alluded to, there's other issues with the COVID vaccines not hitting up, curing all variations of the virus. And I think you can have confidence that the market will rebound. So don't fall for, as one of my wise portfolio managers says, there's people out there that are going to be trying to sell books and they're going to want to hit the timing right if the market does drop. And but you can feel comfortable that as long as you have the reserves, you can stick to your plan and take some risk by so that you get the reward. And as long as you're working so closely, you can do that. A couple from my many meetings with clients during investment reviews, if you're already in a situation where you've sold out because you were scared, it's hard to tell that client that was a mistake, because they're the ones that are that have made it big enough that they can be your client, and so they obviously have to have some smarts. But I have seen where people have invested in a stock and it has done really well, and they've stuck with it, and they've said to me over the years, if I had listened to the first broker that told me to diversify, I wouldn't be where I am today. But I've had the fortune of seeing, fast forward another 10 years, 15 years past that comment, and that stock has stagnated. And had they diversified overall, they probably would be better off. So sometimes the worst thing that can happen to somebody is they have a big win, and then they think that they know it all, and they're hard to listen. It's hard for them to listen. I often deal with the widows and divorcees, and they're very good because they maybe haven't always studied this as much, and so they're an open book and they're willing to listen. And I've seen fortunes of the other party dwindle because they're still thinking that they're making the right decisions, and the spouse has been able to invest their monies and live on them for years and years and years, and do quite well, bring their help with their families, everything. So it's good to seek advice, and if you have a good win, congratulations, but I think you should still listen to the experts.
Right. Well, I think you hit the nail on the head with the get to know your financial planners and bankers. I can't tell you how many conversations I've had with business owners and managers and leaders just about how absolutely essential those relationships have been this past year. So thanks to both of you for all the work you do and for the great advice. I think today, I believe, is the actual anniversary of the pandemic being declared 1 year ago. So crazy to think about, crazy that we're still in our home offices, and yet so nice to be talking about planning. And in a year where uncertainty was the buzzword, it's nice to be talking about things that are somewhat optimistic and hopeful and moving forward. So thank you both so much for all of the advice, Marianne and Bill. We so appreciate it. And thank you to our sponsors, RBC Wealth Management and Minnesota Bank and Trust, for making this event possible. Thank you all for sharing the lunch hour with us. We're going to make this webinar available on our website at tcbmag.com in just the next couple of days, so you can share it again, or if you didn't get all the details down, you can go back and take some notes. Have a wonderful afternoon, and hope you come back and join us for another conversation again soon. Take care.